All right, let's dive right in. Today, we're talking about something you might think is only for the Wall Street pros, derivative hedging. But this explainer, this is about bringing those same powerful tools to you. So let's get into it. Just think about that for a second. I mean, we insure our cars, we insure our homes, our most valuable physical stuff, right? We don't just cross our fingers and hope for the best. So why do so many of us do exactly that with our life savings? What if I told you there's a way to get something that acts just like an insurance policy for your portfolio?
And this, right here, is the fundamental difference in mindset. You know that feeling when you're just hoping your portfolio bounces back? Well, that feeling is a big red flag that you've lost control. Professionals don't operate on hope. They use specific contracts, options to create guarantees. It's not about trying to predict the future. It's about controlling your potential outcomes no matter what happens.
Okay, this slide is a real reality check. We've all heard about the so-called safe havens, right? Gold, Bitcoin, things that are supposed to zig when the market zags. Well, look what actually happened during the last big crash. They pretty much plummeted right alongside stocks. It just goes to show you that when a real panic hits, everything kind of gets dragged down together. Simple diversification just wasn't enough. You need a tool that actually works because the market is falling.
And this perfectly captures that core shift in thinking. The amateur approach is passive. You diversify your portfolio, and then you just hope. You're a passenger. The professional approach is active. You use specific tools to hedge your risk and control the outcome. You become the pilot.
So what is this powerful tool? Well, it's options. And I know. For so many people, that word just screams gambling. But we need to completely reframe that. For our purposes today, options are not about gambling. They're about creating guarantees.
And don't just take my word for it. This quote gets right to the heart of it. Yeah, sure, you can use options to make wild, risky bets. But for a lot of sophisticated investors, they serve the exact opposite purpose, to reduce risk. An option is just a tool. A hammer can build a house, or it can break a window. It all depends on how you use it. Here's the single most important mental shift you need to make. From this moment on, whenever you hear the word option, I want you to replace it in your brain with the word choice. That's it. You're not buying the stock, you're buying the choice to buy it or sell it at a price you agree on today for a set period of time. This simple change turns a scary derivative into a strategic tool that you can control. The best way to picture this whole thing is to think of it like a giant insurance marketplace. On one side, you have people who want to buy protection against a specific risk. And on the other side, you have people willing to sell that protection and collect a payment, a premium, for taking on that risk. They're basically acting as the insurance company. And here's the key. You can be on either side of that transaction.
Okay, let's get practical. Our first strategy is called the protective put. This is how you can act as the insurance buyer.
And I'm not just being metaphorical here. A protective put is the closest thing you can find in the financial world to an actual insurance policy on a stock you own. It's a direct, powerful way to protect an asset from a serious drop. So what exactly is a put option? Well, it's a contract, a choice that gives you the right to sell your stock at a locked-in price. That price is called the strike price. It doesn't matter how far the stock falls in the real world, you have the guaranteed right to sell it at that strike price. And crucially, it's a right, not an obligation. If the stock goes up instead, you just let the insurance expire and enjoy all the gains. No harm, no foul. The mechanics are surprisingly simple. For every 100 shares of a stock you own, you buy one put option contract. That's it. The second you make that trade, you have established a hard floor below which your investment cannot fall for as long as that contract is active. Your risk is now defined and totally under your control.
Think about it. Without this, your position is completely exposed. If you own a stock at, say, $100, your theoretical risk is that it goes all the way to zero. That's a huge, undefined, and potentially catastrophic downside.
But after you buy that put, the entire risk profile changes. This graph tells the whole story. Your upside potential for profit is still unlimited, minus the small cost of the insurance. But look at the downside. The line just flattens out. That flat line is your price floor. Your strike price could be $90. The stock could fall to $1, and you'd still have the unbreakable right to sell your shares for $90. You've created a guarantee.
And here's the kicker. Most people assume this kind of ironclad protection must be incredibly expensive, but it's really not. The cost, the premium you pay, is often just a small percentage. Think maybe 1 to 3% of your position's value to get months of protection. It's a small price to pay to eliminate the risk of a catastrophic loss and sleep well at night.
Okay, so that's how you buy insurance. Now let's flip to the other side of that marketplace. Let's see how you can be the one selling insurance to generate some income. This strategy is called the covered call. This quote says it all. With this strategy, you get to act like the insurance company. You get paid a premium upfront, and in exchange, you agree to take on a very specific, calculated risk for someone else. So to do this, we use a call option, which is basically the opposite of a put. A call gives the owner the right to buy an asset at a set price. What we're doing is selling this right to somebody else. It's called covered because we already own the underlying stock. We're promising to sell our shares at the strike price if the buyer wants them, and just for making that promise, we collect a premium today.
Now look at what this does for your investment. That premium you receive directly reduces your cost basis. For example, say you own an S&P 500 ETF. You could sell a call option against it and collect a small premium every single month. That income could be enough to pay for your insurance put, or heck, it could even just pay for your Netflix subscription. The point is, it lowers your break-even point and creates a buffer against small dips. It's like creating your own dividend.
And now for the pro-level move where we combine these two ideas. Let's talk about the collar. This is where the real synergy happens.
This is where it all clicks together beautifully. A collar is when you do both things at the same time. You sell a covered call to generate that income, and then you immediately use that exact same income to buy a protective put. The premium you collect from selling insurance pays for the insurance you're buying, and the result? You can often create this protection for a very low cost or sometimes even for zero cost. You've now locked your stock into a defined price range, a collar, where you cap some of your potential upside, but you completely eliminate your downside risk. It is the ultimate defensive play.
All right, let's bring this all home. Learning these strategies isn't just about a few new tactics. It's about a fundamental mindset shift in how you view the market and your role in it.
Here's the bottom line. Most retail traders hear options and they immediately think of gambling. Buying those cheap, out-of-the-money calls and praying for a lottery ticket payout. The strategic, professional approach is the complete opposite. It's using options not to hope for a huge return, but to guarantee and define your maximum loss. That isn't gambling. That is the very definition of risk management.
Ultimately, this all comes down to a new perspective. Risk isn't something to be feared or avoided. It's a variable to be managed. Once you realize you can move from simply hoping to actively hedging, it opens up this whole new world of control. And that really makes you wonder, doesn't it? What other professional-grade tools are out there, hiding in plain sight, just waiting to be understood?